Hello, everyone. There are definitely lessons that we should learn from the recent bank collapse, which is SVB and Signature Bank. And in this video, I'm going to share with you three things that you should learn from this and what you should do going forward to make sure that your money, your deposits, is protected at your bank. Hello, my name is Dr. Sa. So, what happened in SVB can happen to any of us. Yeah, first of all, prayers and well wishes to those that are affected and those that are impacted. Let's go back, high level, kind of, the background to this whole case and why we're here today, why this happened. There are various players that contributed to this bank collapse. First of all, politicians played a huge role in this. Bank regulators played a huge role in this. The Feds also played a huge role in this, and as well as the company executives also played a huge role in this by taking on more risk than they should have. The Fed's definitely raising interest rates since last year, and also politicians lobbying to remove some of these regulations that would have safeguarded this catastrophe from occurring. All right. So COVID brought a lot of changes, as you know, to the world. And this created a huge opportunity for the tech industry. So back in 2021, the tech industry was booming. Interest rates was near zero. Of course, SVB Bank being bank for tech companies, a lot of people felt comfortable to put their money in this bank because the bank will invest their money into bonds. Now, fast forward to 2023 or 2022, the Fed started raising interest rates. As interest rate continued to go high, values of bonds depreciated. So the money that had been invested had depreciated in value. So in order for SVB Bank to stay solvent, they had to sell their bonds at low value so they'll be able to have cash to meet withdrawal demands from depositors. And this is what actually, high level, what created this whole issue. So when it became obvious that the bank was making losses, those that had deposited their money with the bank wanted to withdraw. And of course, if everybody should go to the bank to withdraw their money, the bank is not going to have enough to be able to meet the demand. Why? Because when you deposit your money into the bank is allowed to use that money to invest, which is called fractional reserve. I think the bank is only allowed to keep 10% of your deposit. The 90%, the bank is allowed to invest it into something. So with these little, small regional banks, when they invest it and the bonds reduces in value, they have to sell their bonds. It becomes obvious for depositors and they want to withdraw the money, and unfortunately there is not enough money. So that is what actually caused this bank to collapse. And the interesting thing about this is that 90% of the deposits with the bank were uninsured, which means that 10% of the deposits were less than $250,000. According to the FDIC, the federal government would insure deposit up to $250,000. So if you have let's say if you have $500,000 with a bank, and something happens with the bank is going to close down. The federal government can guarantee you withdrawing up to $250,000. It's insured. The remaining $250,000, it's not insured. So it's possible you can lose it. That is very risky, and that's something to think about. And so, yeah, though the government, Joe Biden, came out that the depositors will be able to withdraw all of their money. But the other thing for me too is that if the federal government is able to make this caveat for SVB to cover all depositors, that will include those that have more than $250,000 in their account, then why not do it for all other banks as well? right? Not why just SVB Bank or Signature Bank? Why not all other bank as well? What is good for one should be good for all. That is just my own personal opinion. Let me know what you think about this in the comment. So back to the story. There are really lessons that we should learn from this going forward. So what we should all do is think of diversifying our deposit. I think with this case study, it makes sense to have multiple banks, especially if you have more than $250,000 in liquid cash. It wouldn't make sense to store all your eggs in one basket, that if something should happen, you have no access to it. Or if you have more than 250,000 sitting in one bank and something happens to it, the federal government is only able to insure up to 250,000. You lose the remaining. So if you know you have more than $250,000 in liquid cash, it's advisable to keep your money with multiple banks, so all your eggs will not be in one basket. The other thing is, think of investing. A lot of people don't believe in investment. I used to be one of them. Years ago, I worked for a company during the 2008 crisis, and also during the BP oil spill, I believe in 2010. And I worked for a law firm that handled the settlement for those that were impacted during the 2008 Lehman Brothers and the stock market crash. And I saw a lot of people losing their investment. People that had thousands, hundreds of thousands in investment, and they ended up receiving $500, $1, $50, $100, and it was very scary. So I made a decision that investment is not for me. If somebody invested this amount of money and this is what they got back, that is really concerning. So I made a decision not to really invest in anything. By years down the line, I've been fortunate to read a lot of books that really educate on investment, different types of investment, how to even invest in stocks, how to invest in mutual funds, and all of that. And I realized actually there's some great value in investment, especially if you have cash that you think you're not going to need anytime soon. If you have cash that you can risk, because again, you are risking for a return. And if you're able to tolerate the risk, then you should invest. So think of different ways of investing. Because if you take your money and you go and put it in a bank because you don't want to deal with any risk, bear in mind the bank is regardless going to invest your money anyways. According to the fractional reserve, the bank is only required to keep 10% of the money that you deposited. The remaining 90%, they can invest it in anything that they want. So if you are not investing your money, especially if you have cash that you don't have the need of it, you're not going to use it right away, and you put it in a bank, it's like giving money to them for free. Hey, I want you to keep my money for me for free. Go and invest it, make profits of it, and give me some change. How much do we get in savings? The national average yield for savings account is 0.23%. Okay, this is the national average, so it's not even up to 1%. So whatever money that you are going to keep in your savings account with the bank, they're going to use it to invest in something they want, make profit of it, and keep it for themselves. Then they're going to give you 0.23%. Now think of this, if this is wise or smart decision. I don't put my money in savings bank, especially for funds that I know can be invested in an asset. Because why? If I keep it in the savings account, the bank are still going to risk it regardless. So why don't I take it and invest in something that I want? You can invest in real estate. You can invest it in stock. You can invest it in 401k. You can invest it in life insurance. There are a whole lot of investment opportunities that you can look into, and maybe something that I can cover in my future videos as well. But going back to this video, think of investment, especially if you have cash, liquid cash that is sitting around doing nothing, rather than sitting in a savings account that the bank is going to invest and make returns of it and give you 0.23%. You should invest it and you make 12% a year, or you make 10% a year. Yeah, right? It makes sense to me. The other thing that you can also consider doing is banking with the big guys, right? Why? Because these big banks do have large investment portfolios. They have the diversified portfolio. So should anything happen with one section of their portfolio, it's not going to impact the other areas in their investment portfolios. So one way or the other, your investment or the money that they invest is able to absorb any uncertainties that could happen. These banks could be Chase, it could be Wells Fargo, Citigroup, or even Bank of America. These banks, they have huge assets in trillions. So definitely your money can be safe if you are banking with them. But again, like I always say, if you have more than $250,000 in a bank, my advice, put it in different banks. And if you're going to put more than $250 in a bank, why don't you invest it in something else? Why don't you invest it in real estate? Why don't you invest it in stocks? So think of this as well. Now with SVB Bank, they required that if they were going to loan any money to any tech startups, that they are required to save their money with the bank. And what this means is that if I'm to go for a loan from SVB Bank, I'm required to keep my money with the bank, which is also another risk. And I think that is what actually happened with most of these companies, because think of it, that 10% of the deposit with SVP Bank are actually insured, which is what means is that 10% would have money less than 250,000 or up to 250,000. The remaining 90% are more than $250,000. These are companies, and all these people and companies are impacted because of this. So if you're going to get a loan from any bank at all, and they are requiring you to save your money with them in order for them to give you the loan, negotiate the terms so you don't end up keeping all your eggs in one basket. Also, one lesson we should learn from it is it's advisable to have some cash on hand. You never know, there could be an emergency that you may need cash immediately, and you don't want to be stuck. You want to go access your cash and you can't get it because the bank is not available for whatever reason. So it's advisable to keep some cash. I'm not saying keep all of your money on hand or at home with you. That is absolutely not smart and safe anyway. So, but it's advisable, keep something on you, especially for rainy days. If anything should happen that you need cash, physical cash right away, you'll be able to tap into that cash reserve that you have to be able to meet that immediate need until you're able to have access to your money at the bank. Well, guys, these are the lessons that I have drawn from these bank collapse, and I hope you consider these lessons when you're making decisions with how you bank. Well, thank you so much. This is all I have for you today. If you like this content, subscribe to this channel, like this video, share with your friends. I'll see you in the next video. Have a good one, everybody.